TC Energy beat Q2 consensus across the board. I mean, adjusted EPS came in at 68 cents, beating the 61-cent estimate, and revenue hit 2.82 billion, which topped the 2.75 billion consensus.
Yeah, and the forward guidance totally backs up the beat, too. Management expects full-year comparable EBITDA to hit the absolute upper end of their 11.6 to 11.8 billion Canadian dollar range.
Right.
But as for the stock reaction, shares actually popped about 1.2% on the print initially, but then they gave it all back the very next day.
Yeah, fallen 1% because, a spike in 30-year U.S. Treasury yields basically pressured the broader midstream sector.
Exactly.
So we are digging through our stack of earnings reports, analyst notes, and management commentary today because behind these headline numbers is a pretty wild story.
Oh, absolutely.
Right. I mean, a multi-billion-dollar nuclear project finished early, and management is basically using that massive cash injection to pivot hard into the AI data center boom.
It's a huge pivot.
So our mission for this deep dive is figuring out exactly how they pulled this off and whether they can actually fund this massive AI expansion without going broke.
Well, the broader market might have gotten spooked by those treasury yields, but if you look at the actual cash TC Energy is generating, a totally different story emerges.
Right.
They pulled off a really solid 22.2% net margin and a 12% year-over-year jump in comparable EBITDA.
And that doesn't just happen by accident.
Yeah.
What specifically drove the core beat here?
So if you look at the segment breakdown, two areas really stand out. First, U.S. natural gas pipelines saw a profit jump, 11.8%.
Okay.
And that was mostly driven by higher flows and asset availability. But the real needle mover, the thing that caught everyone's attention, was the power and energy solutions segment.
Right.
That spiked 20% year over year.
Wow, 20%. And here's where it gets really interesting for anyone following their infrastructure. That power segment spike is heavily tied to the Bruce Power nuclear facility, right?
Yeah, exactly.
Because Unit 3 returned to service 7 months early and like 15% under budget. I mean, finishing a nuclear overhaul early is basically like finishing a massive highway project ahead of schedule.
That's a great way to look at it.
Not only do you stop burning cash on construction costs, being 15% under budget, but you also open the toll booths 7 months early. It instantly floods the balance sheet with high-margin cash flow.
Exactly. It completely changes their near-term financial picture. And if we connect this to the bigger picture, that immediate cash flow generation is just critical for how management plans to capture future demand.
Which is all about data centers right now.
Right. They are aggressively positioning for the AI data center boom. Management significantly upgraded their long-term outlook, and they're forecasting 51 billion cubic feet per day in incremental North American natural gas demand by 2035.
That is a massive number.
It is. They see natural gas as really the only realistic way to feed this massive wave of electrification.
You don't just flip a switch to start supplying data centers, though.
Sure.
I mean, I was looking at their asset map from the earnings presentation, and it seems their strategy relies heavily on the fact that their existing pipelines are already sitting right next to where these new AI power grids are being built.
Yeah.
Are they just banking on that incumbent advantage?
That is precisely the play. To capture this, management has already sanctioned 3 billion Canadian dollars in low-risk growth projects year to date.
Okay.
Because their pipes are already in the ground near these key tech hubs, they can build these smaller bolt-on connections to power plants much faster and cheaper than a competitor trying to lay brand new pipe across the entire country.
Right. They want to be the default energy supplier for the whole AI revolution.
Exactly.
Okay, I get the bullish growth narrative, and it's a great pitch. But if you are an investor looking at the long game, we have to push back on the balance sheet reality required to actually fund this stuff.
Oh, for sure.
Because they have dividend payout ratio sitting at a pretty strained 98% of earnings.
Yeah.
If they're paying out 98 cents of every dollar they earn just to maintain their dividend yield, they have practically no internal cash left over. That mechanically forces them to find outside money.
It does.
So how are they funding the 6 billion Canadian dollars they've projected for 2026 capex?
Well, this raises an important question, and it's absolutely the core bearish risk for the stock. They are operating with severely elevated leverage.
Yeah.
They're looking at a 2.25 times debt to equity ratio. And even more concerning in the short term, they have a tight 0.65 current ratio.
Meaning for every dollar of short-term debt due in the next year.
They only have 65 cents in liquid assets to actually pay it.
Wow.
Spot on. When you combine that liquidity crunch with paying out almost all your earnings to sustain a yield, Funding massive AI expansion means you are relying heavily on asset sales or, joint venture financing just to keep the lights on and the pipelines growing.
So no room for mistakes.
There is virtually no margin for error. If an asset sale falls through or if interest rates stay higher for longer, that math gets incredibly ugly.
Which leaves you with a final question to ponder as you watch this space unfold. As data center energy demands skyrocket, can a highly leveraged, yield-heavy midstream company successfully pivot into an AI infrastructure growth engine without ultimately having to slash its beloved dividend to fund the capex?
It's the multi-billion-dollar question.
Be sure to follow the show for daily no-nonsense earnings coverage.